Welcome, welcome. Thank you for coming along to a Carbon Trackers event on oil and gas. I really appreciate you schlepping in from one side of town to the other to find this location, and pleased to see some familiar faces and friends. And being Carbon Tracker, we have in this room, we have some oil and gas companies and oil and gas executives and people working in the industry, and we have some campaigners who are trying to end the oil and gas industry. That shows how collaborative we are. We can bring them all in one room together, and everyone's welcome to the party. And we've got people who like to do research and analysis, which is of course at the heart of Carbon Tracker's work. So I'm going to open my remarks by, I think, just reminding ourselves where we are from a climate point of view and from an investment point of view. So from a climate point of view, here's some of those headline figures again. I think you know what they are. We have a remaining carbon budget to 1.5 degrees with a 66% probability of around 300 gigatons of carbon dioxide. And we emit somewhere between 46 gigatons and 50 gigatons a year. So if you do your maths, within the next 5 or 6 years, we're going to be seeing the conditions associated with 1.5 degrees of warming. We're at about 1.36. We're heading towards 1.5 something. We're at 1.5 already. Based on the current emissions, unless we bend that curve, we're going to see 2 degrees not shortly long after that, maybe another decade and a bit. And of course, we've not seen these temperature rises well, we've not seen these concentrations of CO2 for 400,000 years. We've not seen these warming levels, certainly for human life on Earth, and we probably don't want to see it go beyond that. But when we analyze the investment plans of the oil and gas sector, and this is what you'll find different about, I think, the analysis that Carbon Tracker does and our allies, is by linking the forecast the IEA make and the IPCC make, which at the end of the day are forecasts, by linking it back to the reserves companies are actually developing, you can actually truth what the warming outcomes are going to be based on what we know the investment plans are of coal, oil and gas majors. And in our report we published a few months ago, we found that there's 1,000 gigatons of carbon dioxide owned by publicly traded corporations like Exxon and Shell and BP. And there is around another 3,000 gigatons of carbon dioxide owned by governments. So that allows us to say with some certainty, 90% of the world's reserves have to stay in the ground. But the plans of the majors and the plans of the banks are to continue to invest in the expansion that we're seeing in coming years. And that represents investor risks. And Carbon Tracker would probably be best known for linking that to the economic idea of stranded assets and publishing our work on unburnable carbon in the stranded assets. So if you're an investor, the real question is, are these companies worth more by growing and continuing to do the same, or are they worth more by changing strategy and managing the decline? What's better for the shareholder? What's better for the balance sheets of the company? And this is the kind of research we think Wall Street should be doing. Carbon Tracker is exploring it a little bit, but it does set the scene as to why we think this is an important issue. So I'm going to finish my remarks here. I'm an optimist. I think that we can bend the curve. I think the adoption rates for electric vehicles that we saw, Bloomberg New Energy Finance forecast that by 2030, they expect 50% of car sales in the US are going to be electric vehicles. If that's true, then we're going to see a lot of demand destruction in oil and gas, purely because of the energy transition. So that's the reason why I have my optimism. And the great thing we're going to know in our generation is we're all going to come back in 10 years' time and see, did we get it right or did we completely blow it? In which case, I'm heading up towards Greenland or North Canada, probably followed by about 1 billion other people if we're lucky to find ourselves in any space when we're up there. All right, so I'm going to hand over to my great colleague, Mike Coffin, who's the head of our oil and gas and mining team, and I look forward to your remarks.
Brilliant. Well, good afternoon, everybody. Thank you for those introductory words, Mark. So what I'd like to do over the next 20 minutes or so is really just go into a little bit more depth on some of those themes that Mark's highlighted there. Really a bit of a whistle-stop tour of some of our research on stranded assets, climate alignment, transition risk, and ultimately the implications for a whole different for different groups of stakeholders, but also really to set the scene for the latter part of today. So obviously, while we'll be talking about stranded assets, but really then my colleagues will be going on to talk about stranded liabilities and some of the implications for retiring and what are the costs retiring all this infrastructure that's associated with oil and gas that's been put in place, and actually who's going to pick up that cost. So to set the scene, so sort of there we go. Right. So this is the first slide. This is really just to reiterate the point that Mark made right off the bat, that to limit warming to 1.5 degrees C, 90% of fossil fuel reserves need to stay in the ground as unburnable carbon. It's perhaps a little bit small at the back, but on the left-hand side, we've got that 3,500 gigatons of CO2 embedded in the reserves, be that gas or oil and coal in proved reserves. And on the right, for those in the room, we have the remaining carbon budget at the bottom wedge to 1.5 degrees C, so that's about 300 gigatons. That middle wedge in yellow to 1.7 degree, and then that top wedge is 2 degree. But of course, a number of people say that it's not really a listed company problem, that actually that bulk of that's the coal, it's the national oil companies, the state-owned enterprises. But I think if you look at just the reserves of the listed companies, in that middle column, actually the reserves embedded in listed companies alone, excluding the national and the state-owned enterprises, takes us to 2 degrees and beyond just on those reserves. So it very much is a listed company issue. And of course, growing awareness of climate change, massively increasing societal awareness of climate change, but obviously also the physical effects are now being felt here today and increasingly so, and will absolutely be increasingly felt over the coming decade. So what does that do? Well, that from a financial risk perspective, the risk of policy action on climate clearly creates a significant risk to oil and gas companies. And it's not just the producers, it's those throughout the value chain are exposed to the risk ultimately of policy action on climate impacting demand for those projects. But of course, it's not just policy action that's driving this transition. Through previous sort of subsidies and the incentivizing development into renewable technologies, they're now at a place where the costs of renewables are falling, so they're now financially viable in their own right, even without sort of those subsidies. And in many parts of the world, renewables are cost comparative with fossil sources of energy. So what that does is now accelerates that transition. And so it's not just policy action on climate that creates the risk, it is the substitution of fossil by new energy sources. So, and actually we see that as that accelerating and potentially impacting demand quite substantially. So Mark mentioned in his opening comments electric vehicle rollout. And obviously in Europe, we've seen that accelerate very rapidly over the last few years, led by some countries. So for example, Norway, I think it's over 50% of new vehicles sold in Norway are now electric vehicles, opposed to internal combustion engine vehicles. And other countries will be following along that same curve. So mobility is the biggest oil demand sector, actually. So this is in emissions, this chart, but that left-hand column that we see here is oil split by the use sectors. And that big chunk in the middle here is mobility, so predominantly ground transportation. Now, obviously, 50% of oil demand is used for a sector which is potentially rapidly transitioning its use away from internal combustion engine vehicles towards electric vehicles. And so for that example, I've got these two charts. So on the left, you're looking at basically market adoption from 0 to 100% of electric vehicles globally, and we're here sort of approaching 10%. But this is an S-curve, and my colleagues in the energy transition team would encourage me to talk about the fact that technologies don't roll out in a linear way. They take a lot of time to get going, but then they can rapidly accelerate. And that's the place we're at right now and in the years to come. So what does that do for oil demand? Well, we'll see it peak, sort of around 50 million barrels of oil equivalent a day, and then potentially rapidly sort of fall and then plunge through the 2030s. So this isn't a linear transition, and that is quite a drastic reduction in demand for oil based on the rollout of EVs. Now, of course, the industry may say, well, that's okay, we can find other things to fill that wedge, to other demand sectors to still buy our product. And companies may appeal to increased plastics use in other parts of the world to ultimately to sustain oil demand and therefore justify continued supply at existing levels and potentially even growth. Now, given mobility is 50% of the issue here, or 50% of the market, actually you need an awful lot of petchems demand to replace that from a supply demand perspective. And actually, if you look at petchems, there's a whole that industry in itself in terms of moving towards more sustainable petrochemicals and plastics as well. So that is certainly not a given that it's going to continue. Now, those two things, policy action and rise in new technologies, ultimately creates a bit of what we would say an existential crisis for the oil and gas industry. It's not business as usual. This is around the risks that there's faced to their existing business model. This isn't saying that we're not talking about the moral imperative. I mean, I think we'd all hope that I think we'd all in the room agree that we need to move away from fossil fuels, but actually this is just purely a financial risk argument that we're looking to push through here. So irrespective of whether you look at it through a low carbon or a fast transition lens, either way around, we can see that demand falls through the energy transition quite rapidly. And so this is a slide here, and again, sorry, it's perhaps a bit small in the back of the room, but we're looking at the future supply from existing projects in grey out over the next 2 decades. And then you have in the green line here through the centre of the chart, it's a 1.5 degrees C scenario, the net zero emissions scenario from the International Energy Agency. So you could view that as a 1.5 degree scenario, and we can see that ultimately you don't need any new oil and gas projects to satisfy demand under that scenario. But alternatively, you could look at that in terms of a fast transition lens as well. So low carbon, fast transition. If the companies are planning on business as usual, so more like the orange line at the top, which we see is broadly the same as the IEA's stated policy scenario, about 2.7 degrees C, a slow transition scenario. If you're planning from this demand, but actually demand falls something along that line, there's an awful lot of new projects that are not needed, that will be sanctioned, but ultimately are not needed. And so they'll either contribute to taking the world beyond finite climate limits and beyond the goals of the Paris Agreement, or 1.5, or well below 2, or those projects will potentially destroy significant or erode significant amounts of value. Ultimately, those projects will go ahead, they will not return or give the return on capital that would be expected of those projects at sanction. Ultimately, there's significant opportunity cost associated with that capital. Could have been deployed elsewhere for investors to give a return to investors. So really, just to spell this out, lower than expected demand impacts future returns. So lower demand, fewer new projects needed under lower demand, which means you need lower long-term commodity prices. Obviously, there'll be volatility based on shorter-term demand shocks, as we've seen in 2 different ways in the past 30 months. But lower demand, fewer projects, lower pricing needed. And ultimately, it's critical that companies plan for this falling long-term demand. That rollout of electric vehicles on that curve will accelerate quite rapidly. And I think Mark mentioned there a stat of new vehicles being electric vehicles out to 2030. But if you think about an oil and gas project, it lasts, its production lifetime would be 20, 30, maybe even 40 years. So really, it's the comparison between those 2 timescales, which is one of the key drivers of risk here, and potentially one of the key drivers of value erosion through by sanctioning assets that become financially stranded as pricing falls away. So why do you care, and who should care? So sort of just thinking about the implications for various groups of stakeholders, and I identify 3 main ones here, but of course there are many others, both companies from upstream oil and gas production companies, but other companies throughout the value chain, be those refiners, be those midstream companies, or be those service providers, or even equipment manufacturers. All of those will be impacted by reduced long-term demand. But actually from the financial stakeholders, sort of identify 3 key ones here. The asset owners, the asset managers, and on the right, that's policymakers. And so for the asset owners, well, actually, do the assets that investors are exposed to by investing into oil and gas companies, are those assets still sort of matching the liabilities of the asset owners? Does the strategy does it support the goals of their beneficiaries? So actually, in terms of long-term growth, returns over that period, but risk-return profile, but also beneficiaries' wishes around investing more sustainably, i.e., and some do no harm, but also wishes around investing for impact, i.e., investing into those companies that are positively acting to accelerate the transition and build the new system. So I think it's really important to differentiate between those two. On the one hand, sort of investments that are not invested in the old and reducing that exposure, both from a climate alignment and sustainable investing perspective, but also the investing in the new, the impact. So looking to the next group, the asset managers, clearly getting this wrong and portfolios that are overly exposed to oil and gas. As the asset owners change what they're looking for from their investments, there's a risk of loss of assets under management. I think it's really important to separate the short-term growth versus the long-term strategy, particularly in areas where you've got shocks which are driving high prices, particularly in the short term. And then the final point, I think something we're really keen to push. Actually, we hear a lot about passive investing and passive investments and the indices and tracking error. And actually, the investors are not able to move away from oil and gas because of sort of the constraints. But actually, are asset managers using appropriate indices when they're constructing their portfolios? And their benchmarks. And then on the final group there, the policymakers, we put out a report last year, the impact looking at the impact to national reserves, national revenues. So we looked at the petrostates and understanding that if you've got a loss of lower demand in the long term, reduced pricing will actually materially impact the revenues that oil and gas producing nations will achieve from their resources. That doesn't mean they should invest into more. They're potentially wasting even more money. But actually, it's about these economies that are built on oil and gas reducing their exposure. But then also for the non-oil and gas producing nations, so actually the UK or for the US, understanding the degree to which your stock exchanges and your financial systems are exposed to some of these risks as well. We think that's really important. And that was one of the focus of that report that Mark mentioned, Unburnable Carbon 10 Years On, we put out in June. It's really important to look at the role of subsidies from a policymaker. And actually, are we perpetuating the old system where those subsidies might be better spent building the new, whether that's electric grids or supporting the rollout of the new technologies we need? And then finally, there's a big question about the compatibility of existing financial systems with sort of claims of climate leadership and national net zero goals, whilst subsidies are continuing to perpetuate the old. So I just wanted to illustrate here sort of what are the oil price implications of the transition. And so what we have here is a cost curve in sort of break-even prices on the y-axis, and on the x-axis, if you've got oil demand and supply over the next 20 years. And then you get a curve here of all of the potential new projects that are available out there that globally, and we get data from a third-party supplier, Rystad Energy. And you can see that you get a curve of all the different project options. And we take when we're looking at modeling global oil and gas supply, we take a sort of economically rational approach to this. And we say that actually, if there's a small amount of demand needed, or a small amount of demand in excess of the future supply from existing assets, which projects would go ahead? And we'd say, well, actually, in an economically rational world, it's the lowest cost projects that would go ahead. And so here with the blue line here, about 5 million barrels a day on average over the next 2 decades is what you see in the fast transition, a 1.65 degree scenario. And actually that gives you an outcome, break-even price, not an input, but an outcome around $35 a barrel long term over the next 2 decades. Conversely, in a slow transition or a 2.7 degree scenario, it's about 20 million barrels a day on average over the next 2 decades. Clearly more of that new supply comes later in that period. But your outcome price is more like around $55 a barrel long term. And this is from a report last year, Adapt to Survive, and we're updating that in the coming months of this year. The absolute price isn't the most important thing here. What is important is you've got a relative price impact of lower demand. You need to incentivize less new supply. You don't need to go far up the curve, and so ultimately your price will be lower. You see a sort of $20 price impact of a low demand versus a high demand scenario. So a fast transition will see lower prices than a slow transition. And that's the real point here. So of course you need fewer new projects, but your existing projects that are already going ahead will see reduced revenue. So you have lower producer surplus for those projects as well. So there's really two aspects here. Your existing projects won't make the returns you expected of them. But then you have this whole set of projects through the middle. So in a fast transition case, lower demand, fewer new projects needed. Or any of these projects in the middle are unneeded. So we'd say those are projects that are incompatible with, from a climate alignment perspective, they're incompatible with a low demand or with Paris. But they're also assets that risk becoming stranded if companies continue as business as usual. These projects through the middle risk becoming stranded under a fast transition or a low carbon scenario. And those are the ones where a lot of that capital could have been better employed elsewhere. And whether that's into renewables or whether it's actually into sort of anything else, the key, that is ultimately up for companies and their investors to decide. But what's key is it's not being spent and invested into projects that are just not needed at all through the transition. So the question there is, how do you quantify the value impact in that? And actually, what we tend to do is look at it in terms of the capital associated with those projects, rather than necessarily the value. Obviously, if you look in terms of trying to calculate the net present value of that, it's very dependent on the absolute prices that you look going forward, and so you can have there'll be a lot of variance there. But actually, the way of quantifying that, particularly in a relative sense, is looking at the capital associated with those projects. And so what we have here is a chart looking at the capital over the next decade out to 2030 associated with new oil and gas projects. So this is capital on new. This is not new capital that's going on or maintenance capital on existing projects. This is the capital that's associated with those new project options that companies could plan. And we see that under a business as usual world, both the yellow and the orange projects would go ahead. And yellow and orange, and we've got that, so that's capex on the left from naught up to $1 trillion shown through here. So that line through there is at $1 trillion. You've got listed companies on the left, you've got national oil companies partially listed in the second column, you've got unlisted NOCs as the third column, and then you've also got a whole series of private companies on the right there. So under a fast transition, none of these projects are needed. So under a 1.5 degree world, you need no new projects. Under a Paris world, so we say broadly 1.65, the IEA's SDS, Sustainable Development Scenario, just the yellow projects are sort of viable, economically viable under that. Under a slow transition, you'd have the orange projects would go ahead. But actually, there is a whole load of projects that are shown here in red that companies have that are not viable even under a 2.7 degree climate outcome. So if companies are sanctioning these orange and particularly the red projects, they're potentially at risk of eroding significant shareholder value. And to quantify that, that's the sort of $1 trillion figure that just for listed companies that could be at risk under a low demand fast transition scenario versus business as usual planning of the industry. So I'm just going to skip on to this slide here, which is to say, so I'll just pause there for a second, but to say that the scenarios we've looked at there are the International Energy Agency scenarios. They're not necessarily forecasts of what is going to happen. They're primarily designed to say, if you want to get to 1.5 degrees C, this is how you might get there, and these are the sorts of things you would have to do. So oil demand would have to fall by this much. Gas demand in different regions would need to fall by this. You would need this amount of hydrogen. So it's a scenario. It's not a forecast of what is going to happen. Obviously, you've got a number. You've got the IEA's net zero emission scenario at 1.5 degree. So you could say that's a fast transition. You have the 1.65 degree sustainable development scenario. So it's a slightly slower transition, potentially still Paris. And then you have the 2.7 degree stated policy scenario, which we see as business as usual behavior. But it's important to note those are not forecasts. And also, I think but it's important also to note that the work our energy transition team and been looking at in terms of the non-linearity, and we saw that in that S-curve of the rollout of electric vehicles. So if you start thinking about the shape of what might happen over the coming 2 decades, it potentially may be a bit more delayed, sort of a slightly longer peak, or maybe even short-term growth, before accelerating sort of fall in demand. And we saw that plunge through the 2030s. So it's important to note that actually, even though we're seeing high pricing right now, and obviously that's impacted by an external shock, that short-term high pricing does not mean that prices will be sustained in the long term, and particularly not sustained over the length of the production life of fossil fuel assets sanctioned today. So returning to the slide, as I say, timeframes are critical. The oil and gas asset lifetimes versus the rollout of new technologies, and also the timeframe over which policy action may occur. Short-term growth does not mean sustained long-term demand. And then the final point, there's significant risk of overinvestment. If you're looking at short-term pricing signals to invest for the long term, it's a particular issue around value erosion. And we just illustrate that with one new scenario on the right. So we have those same three you've been looking at: the net zero emissions scenario, the sustainable development scenario, and the stated policy scenario. We have this fourth scenario here, labeled FPS. That's the forecast policy scenario from the Inevitable Policy Response Programme. And what you see there is, it actually shows short-term growth, and under that, and this is for oil, you have a peak in oil demand at around 2025, but then this very rapid reduction through the 2030s. And so that's a 1.8 degree scenario, but actually oil doesn't peak until 2025. There's a real risk of over-investing here for projects that are just not needed at all through the 2030s. And that's the real risk here. And we put a report out at the start of the year called Managing Peak Oil, and I suppose it sort of does what it says on the tin, in that on the left-hand side here, we considered a high investment case where you see that same scenario now shown in black, and this wedge of red projects. And actually investing in the short term, you end up with massively oversupply in the market in the 2030s under such a forecast. And that's when prices really will go through the floor, and an awful lot of value erosion. Conversely, if you manage the supply and manage the sanctioning here, particularly actually a focus maybe more on short cycle projects versus longer cycle projects, you can more accurately match supply and demand under that scenario and potentially limit the value erosion there. So that was a bit of a whistle-stop tour through some of the key highlights and the key messages that we have around touching on the unburnable carbon, the need for this stuff to stay in the ground, the role and the rise of new technologies impacting demand and together creating significant risk, and ultimately meaning that oil and gas companies' business models must change. And it's absolutely critical that investors recognize that and work with companies and engage with them, but fundamentally scrutinize company plans to understand whether the value of their assets or their investments, is being protected or is at risk. So just sort of leave you with the final few points. The key takeaways really for me were the fast transition, irrespective of the driver, reduced demand, lower revenues. Companies absolutely must plan for the peak to avoid wasting capital. And then finally, it's critical that investors, both the asset owners and the asset managers, ask whether oil and gas investments are still fit their risk-return strategy as well. So that, hopefully, as I say, that was a whistle-stop tour through some of the key messages that I wanted to share today. So Henrik and Natalie, could I invite you to come up? And I think we're moving into a sort of more of a discussion as well.
Hello? Yes. Yes, that seems to be on. Fantastic. And yes, thank you so much to Mike for that quick run through of one of the core elements of Carbon Tracker's narrative, which we have been on for the last decade plus. Stranded asset, we can't burn them all. Over the last couple of years, we have also added we won't burn it all, which is our energy transition narrative work stream. And the next presentation after us here will be focusing on who is left to pick up the tab and who will be cleaning up all of these wells that are running empty or close to running empty, and is that taxpayers or is that companies, etc. So I think there is a very good red line through all of the work that we gone through here today. But I think we wanted to dive a little bit further into what does this actually mean, the unburnable carbon 10 years on. I think it's bleak reading, of course, and bleak results that we have more listed fossil fuel reserves now, 10 years later on. As I think as Mark Campanale typically says, well, maybe our campaign has not been super successful for Carbon Tracker, but I actually think we have been super successful with all of this work because everybody is now focusing on it. There's still a lot of people who are doing a lot of the things they shouldn't be doing, but that's one of the things we're going to be talking a little bit about here today. So we're very happy to have Natalie Wallace, Global Head of Sustainable Investing for Natixis Investment Management. And then, of course, Mike, our global head of, global head of, I guess we can call it global head of oil and gas and mining research for Carbon Tracker Initiative here, to discuss this here. And what does this actually mean for investors, and how do we implement a lot of these things we talk about? We talk about scenarios, we talk about disclosure, and so on has been the topic of the discussion earlier today. But maybe, Natalie, we could start a little bit with you to hear a bit about what is overall your responsibilities for as head of sustainable investing for Natixis, and how do you navigate stranded assets?
Right, so I'll start with maybe a quick presentation. Thank you very much, Henrik, for having me here, and Mark for inviting me and the whole crew at Carbon Tracker. It's been a pleasure, by the way, to work with Carbon Tracker. I've changed a lot, but I've known many members who stayed steady into their strategy and Vox Clamentin deserto, less so now. And yes, there's more work to do, absolutely. So Natixis Investment Managers is asset manager composed of multi-boutiques. You might know in the US, Loomis Sayles and Harris, who are a big part of our stable of investors. One characteristic that is very different maybe from other large investors is that we are active, very active. So we don't do passive investments. We have very high active share, as we say, meaning that we tend to try to project ourselves and the money we manage on behalf of our investors towards 3 or 5 years, and say what is going to work over that time period, and select securities, being in bonds or sovereign or corporate, as well as equity, as well as private assets that are going to do well in this environment, and yes, contribute to the development of sustainable trends. So this is our dual objectives. My responsibility is tiny, if you will, that I'm trying to have others work for me. I'm a very lazy person, which is we talked a lot here about transformation of economy, and that's what I'm experiencing at the Natixis Investment Manager, is a transformation that is sometimes forced by the regulator. I'm talking about the European Commission right here, and their regulation on investment products, ESG investment products. But it's also to and I mentioned what we are experiencing with our clients, which is we started this journey on sustainable investment, SRI, ESG, whatever acronym or words you're using, by having a sleeve, by having a head of stewardship or a head of sustainable investment or head of ESG. What we're experiencing today, and our clients, asset owners, as well as us, it is about, I call it total portfolio activation, or total understanding of the risks, especially here climate risks that an organization is facing, not only through its business, which is investments, but also through its corporate. And we've seen that over the last 10 years. Call it mainstreaming, call it whatever, but it's going from a sleeve. So I'm going to exclude some stocks. I'm going to invest in low carbon indices or low carbon active products. Or I'm going to allocate from 1 to 2 to 10 to 20 billion to now it is the chief risk officer's responsibility, or the chief investment officer, and they all report to the CEO, who reports to the board. And that's a massive change, I think. So unfortunately, we'll talk about that. We still need to see the real outcome on the real economy. We see the transformation. We haven't seen a positive trend in emission around the world.
Yeah, and that leads me to the next question, to maybe also to Mike, to maybe comment a little bit more on the conclusions from our 10-year report and so on, because it seems that a carbon tracker has been shouting about this for a long time, but people have not necessarily been listening. What has all gone wrong, and what should we do next? I know that's a softball question here.
Yeah, I mean, it's quite a big question as well. So obviously in the report we found that, or identified that actually that the emissions remaining in oil and gas and coal reserves globally were still broadly the same as they were 10 years ago, as you say. But what's changed over the last 10 years? I mean, well, the climate's got warmer. I mean, that I think is one thing, and but societal awareness of climate, I think, has definitely increased. Potential for policy action potentially has increased, but I think it's the individual awareness, that the growth that investors are seeing and the questions they're asking has changed. The company strategies have changed, and the company positioning on climate has changed. But I think it's more. But I think what needs to change is it's not just climate; it's recognition of the transition risk more broadly, and it's the demand destruction that or potential for rapidly falling demand, which is the threat to their businesses that I think is critical. So it's not just climate, it's not climate disclosure, it's transition risk disclosure. And I think that will talk on a number of the themes from this morning's session as well.
Yeah, and I think the most stark result of this here is if we still believe the 1.5 degree scenario or outcome is where we want to get to, it's only around 10% of reserves that are still, I guess we can call them, extractable. With a lot of oil and gas companies, a lot of governments, a lot of companies faced on this year, that seems like a new installment of the Hunger Games we have in front of us. So what can companies do, or maybe more importantly, what can investors do in order to navigate and position themselves there? Maybe first hear what Mike has to say, and then we go to the investor and say, what are you doing to avoid being one of the first one that goes out in the Hunger Games?
So I think also, just before I answer that, I'd just say another thing that's changed over the last 10 years, maybe a miss of me not to, would be to say actually the costs of the new energy systems have fallen dramatically, and certainly relative to their fossil counterparts. So that I think is something that is critical to also recognise as a change, and that just the relative pricing will only continue to sort of favour the new technologies versus the old system, at least in a long-term basis. To answer the question there on
what should investors do to avoid being one of the first ones taken out in the Hunger Games?
So I think I'll probably leave to Natalie to ask a bit more on that, but it's really that the investors must, in the round, sort of question companies' plans ultimately in detail. Are companies planning on business as usual demand? Are they sanctioning very long cycle projects, huge capital intensive projects that require payback periods of 10s, 20s, maybe 30 years? What does the production decline from their existing assets look like? Do they need to continue to invest into new projects to get the? Are they seeking to invest in new projects to justify the business as usual, or are they appealing to new growth areas? Are they appealing to petchems, for example, or actually are they recognizing the challenge both of climate action, but increasingly on renewables and other technologies? But I think it's important there to look at the scenarios. So companies may have scenarios, but actually those are all very well, publishing a suite of scenarios into some kind of ESG or sustainability report or climate outlook, whatever you want to call it. But actually, what is the company's internal forecast that they're planning on? And I think that's ultimately the critical piece of information that investors must seek.
Yeah, and Natalie, I think on your website for Natixis, it says you have more than 200 different investment strategies, and you said you're very focused on active management. So how are you navigating this?
Well, are there many options in the Hunger Games? Everybody dies at the end, no?
There's a winner, 2 winners in the first movie, if I remember correctly.
So, well, I was going to say not being linked to an index will be one. Indices are, a representation of past performances. Just one example, Exxon was the largest market cap. What was it, in 2013? And then was booted out of the S&P 500, replaced by kind of new economy. They are doing so and so, whatever. The point is that there is a change in the underlying economy and it's represented on the market, and thus investing into passive or index-related products that are looking at the past might not be the best option in your Hunger Game strategy. I think, one thing is looking again, as I said, as active managers, avoiding being stuck. If you are stuck as a passive investor, or because you think that this company might be on the right track, then it's a question of engagement and proxy voting policy that are outcome-based. What are they based on? Metrics. We think that we have to be careful with metrics that are a big black box, that are a bit marketing-oriented, or are not really linked to real emission reduction. Just this morning, actually, with one of your members on another panel, we've heard that emissions continue to go up. We've seen the impact on our, weather pattern and tragedies in Pakistan and everywhere. But actually, the carbon intensity and carbon emission of the MSCI All World Equity is going down. So there's a disconnect. What is it? We can debate after around cocktail around that. But the point is that we need to really start having tough conversation with companies that we still own in our active portfolios that are potentially high intensity. They might be oil and gas related, they might be coal related or other high emitters, but we want to make sure that they are high emitters on scope 1, 2, and 3, which involves a bit more than just the oil and gas or the fossil fuel related sectors. And we want to make sure that these forecasts or these 2050 commitment on net zero by corporates are actually linked to actual budget cuts or understanding what their carbon budget is in that sector for their activity and how they are going to invest in CapEx, use their balance sheet, acquisition, change of revenue to align with potentially client demand, their cost of goods sold, their sales and marketing expenses, SG&A, whatever that is, that they all focus on, again, that climate risk and their emission on all activities. And we are really trying to go back to, I would say back to, a simple methodology, a bit like an equity or especially an equity analyst that is looking at EPS going forward. We want to have that kind of conversation, which is over the next 3 years, what's your carbon budget and what's your carbon reduction expectation and how is it driven? And go back into each of those lines that are driving that carbon reduction. That's what an engagement looks like. And then if that engagement fails, what do we do? That's all the questions around. Do we divest? That emission is still out there, right? So it can be, basically we would all love to have buybacks redirected to writing off assets, right? That would be the perfect, but is it happening in the short term? That's the key question.
Yeah, no, and I think you touched on a lot of very interesting points here. But as an active manager, you are focusing, you are owning some of these companies, but you also, some of the companies are not necessarily a big part of your portfolio. But as a general thing, there's of course always the divest versus the engagement. I think that's a wrong way of looking at it. They go hand in hand. It's not either or. But as an asset manager, as an active asset manager, do you shy away from owning these companies in such general thing? Is that, let it be somebody else's problem? Or do you want to be part of the energy transition for these companies? It might be more open, more obvious for the electric utility companies, what we have seen Nextera, we have seen Enel, Ørsted, and etc., having been rewarded by the market for their transition compared to some of the oil and gas companies. What is, and having different brands of companies or asset managers, can one own them and the other one short them?
So we are, yes, to all of your questions.
Mike.
Yes, we are multi-boutique. We respect independence of portfolio managers, and that's important because they are here to deliver on risk-adjusted return over a cycle of investment, right? And so that's important for them to have independence. That said, and I'll add a few other things. We definitely engage in transition. And we also have a very specific asset manager called Mirova, who is definitely not in the transition, but definitely into investing in climate solution. That said, that asset manager is 30 billion, and we have 1.1 trillion total. So yes, we are in transition. What does this mean is that we are here to identify opportunities, and then, yes, companies that are transitioning, though in the process of, with a clear plan. We have some companies that are talking about transitioning, but have maybe yet to design a clear strategy. When you look at the allocation per se, you see a lot of them, especially in the high impact sectors, high impact for a real outcome perspective. You see maybe, again, we have 10% in climate solution, but that's typical of the market, by the way. It's not different given our size, but it's 10% in what I say climate-related solution or outcome-based or contributing to that change. And then 20% in transition, maybe 1 or 2% that are yet to, and then the rest kind of less impact in terms of emission, right? So the point is that you want to identify those companies that are transitioning. That's frankly where the rewards are. Sometimes, and I'm sorry to talk technicalities here, but it's important. Sometimes, so I'm going to go back to the boxing of our industry and categorization. So I talked about the index that are past looking rather than forward looking. Same thing with the sector definition. Utilities is definitely changing, and we invest in industrial, but some of our clients say, oh, you cannot invest more than this in utilities or more than that relative to the index. And we keep on telling them the sectors has no meaning here. They are changing, it's transitioning. So there's also a lot of work we need to do on how this real economy is changing, how it's impacting what we call our tracking error, which is what is our risk definition versus a benchmark versus sector diversification. And I'm sorry, this is technical, but this is what we are facing day to day with clients. And so beyond just engagement, there is how do we actually engage with our clients and with regulators and with all other players and actors in the ecosystem to change the view that, again, past sector definition, past index might not be the right way to look at how to invest in the future. And it's a sideway answer, but that's something we deal with every day, which is a difficult part.
No, absolutely. And I attended an event on Monday, and I think somebody came up with a suggestion that, well, tracking error is probably one of the biggest problems we are facing here, because everybody's using the same old benchmark, but they want to fit the new world into this. So the solution would be just to change your benchmark, and then you will be over this issue, I guess. But then there will be a problem with the board of trustees, different
benchmark
places.
agnostics, as we are.
Yeah. So, Mike, going a little bit back to the discussion we had on managing peak oil and so on, and I think one of the interesting discussion from that is, well, it's this long-term, a long-cycle project versus a short-cycle project. A lot of the short-cycle projects are primarily U.S. shale-oriented. Now, we sit here in New York. New York State has banned fracking, but we just have to look across the river, and then you can see out in the distance, you can see Pennsylvania. They have a lot of fracking over there. So what is really the advice you would give to investors looking into these companies? Because if we are right in our overall thesis and assumption, then everybody is going to be scrambling, as I said, in the Hunger Games to get the last oil out. Does that mean the oil and gas shale producers should just get out there and do as much as they can, as quick as they can, to make sure that they get their part of it before Saudi Arabia and so on will be the last man standing?
So, yeah, should the shale producers go all in on the short cycle shale? That's the question. And,
yes.
And so if they, I think it's important to note that yes, short cycle projects potentially are ultimately they're more resilient from the longer term changes in pricing, because ultimately they have shorter term payback periods. But it's worth also thinking about the portfolios that those companies have right now, and that their production is declining very rapidly from their existing production. So their decline rates are much higher than your, say, industry average 5, 6, 7% annual decline. So they're already having to continually reinvest to get revenues and to keep their revenue stream up, and also to pay some of their debt side of things. So to come to a question of should they continue, should they be investing? I mean, from a short-term perspective, potentially, but I think it depends on whether you take a climate alignment or a risk perspective on this as well. I mean, if you want to be aligned, if you're seeking alignment with the 1.5 degree scenario, then no, they should not be investing. And we would say that any investments in new is really incompatible with a 1.5 scenario. If you take a slightly if you have a slightly slower, or view of a slightly slower transition, as we saw in managing peak oil, then yes, there potentially is some space for new oil and gas in the short term from the shale producers. Yes, but just because your time period is your payback periods might be faster, doesn't mean that the project is still breaking even. So it's absolutely critical to look at the break-even prices of those projects as well. And I think in comparison to Saudi, you mentioned, obviously Saudi and some other countries in the Middle East have low cost hydrocarbons, ultimately reflecting the geological conditions and the development environment of those projects. That's all.
Do you mind if I chime in? So I'm not as literate in all the details and data as my esteemed panelists here, but I just looking at the Porter kind of analysis of competitive advantage, and when you look at the energy, it's obviously being disrupted by new entrants. Nothing new up to now, but the new entrants obey to very different laws, right? They're not extractive and laws, they are technological laws, meaning the Moore's law applies. So that's, a no-brainer in one sentence. The second is that the higher the old extractive oil and gas or extractive energy sourced material price goes up, the more demand destruction you have. And then you add on top of that a dust of absolutely necessity for countries to be independent from their energy sources. And I think you have the answer, which is it's looking bad, really. And you add a bit more regulatory and government pressure because of the actual visualization and increased weather events or climate-related distortion of economies and people and society, plus a bit of climate-related migration, a bit to be defined, but most probably enormous. There is no way you want to invest in that industry significantly, a significant part of your portfolio, right? The risks associated with that sector are pretty dramatic.
Great, and maybe there's one additional leg we can put on that, and that's actually what we're going to be discussing here next time, after the break. But maybe hear from you. I haven't prepped you on this question, but that's for the rest of the discussion here. So all of the things we have talked about here is really very much focusing on the ongoing business, but really what we are saying is that fossil fuel extractive companies are not an ongoing business, not a going concern. That means that there's a lot of infrastructure and so on that need to be dismantled, decommissioned, and so on. Is that something that you have started to incorporate into assessment of oil and gas companies? You don't have, if you can say, is that something you hear when you're out talking? Is that something any of your clients are talking about? This maybe mostly to Natalie.
Unfortunately, no. It's simple, sorry, answer, but not enough. I participated with you guys on a panel because that's something that I find that's the black swan. I mean, usually we are, as investors, our work is to assess uncertainties in the future and discount that to now. And there are some that we have, what we called low signals, that are kind of percolating. You're seeing it happening. But that has not even been addressed. And I mean, the fact is that when you're investing in a nuclear plant, and you hear from my accent, I'm French, you have this end of life cost being actually put forward into that investment. What was mind-boggling for me when I read your report and just, why are we not doing the same on all other mining projects and oil and gas and with the disruption that is going on the environment? That was news to me. That was unfortunately not that long ago. And the other part of me, again, I'm French, so a bit facetious, is we always privatize again the revenues and the income, and then we socialize the costs. And I'm afraid this is going to happen yet again. So I'm not bringing good news here, but.
Well, actually, I think it was a very good segue to our next presentations and so on. But I want to thank both of you here before we go to the break. But thank you so much, Natalie, for your participation, and to Mike for your excellent work. And hopefully there'll be a good opportunity also to talk throughout the cocktail hours and so on. But I think we'll stop the fireside here and then go over to a 15-minute break. And then we get a lot more detail on all the things that Natalie have just told us that very few investors are actually considering already.
Fantastic. Hello, welcome everyone. My name is Stephen Greenslade. I am the ARO analyst at Carbon Tracker. That's Asset Retirement Obligations. I'll be speaking in a little bit, but right now I just want to introduce Dwayne Purvis, who's going to give us a really fantastic talk. Dwayne has been a petroleum engineer working in the industry as a consultant since 1995 on matters of reserves, field development, and cash flow analysis, among other things. He's a teacher, he's a speaker, he's a good guy, he's an excellent professional, and I think we're all going to enjoy listening to his talk today. Thanks. Come on up, Dwayne.
Thanks for that, Stephen. I'm not sure I belong here. So my family moved to Fort Worth, Texas, when my dad took the job as the pastor of a small Baptist church still meeting in an elementary school cafeteria. The chairman of the search committee became the chairman of the elders, became my father's best friend and my mentor. He was a petroleum engineer. So when the time came, I went off to his alma mater in the best undergrad program around at Texas A&M University, Whoop. Thank you. Appreciate that. At school, they taught us 3 subspecialties in petroleum engineering. The first is drilling engineering, making the hole in the ground. Second, operations engineers, who you might imagine operate the wells to bring the hydrocarbons up and down the line. And the third is reservoir engineering, which is the study of how much will be produced, how much is it worth, and how do we produce more. That's my work. So the reserves are the fundamental core asset of an oil and gas company. And of course, the warehouse that governs, that holds our reserves are impossible to measure directly. We have to use inferences, and we have a good deal of science to help us. But we still are left with a good deal of uncertainty. And at the end of the day, Engineers like me will publish a report called a reserves report or a reserves and economics report, and then registered professional engineer will stamp those to say, this is our best estimate with uncertainty. So when I graduated in 1995, I went back to work for my dad's best friend, which was one of only a handful of companies in the US who are acceptable on Wall Street to certify as third-party engineers the reserves of publicly traded companies. And for the 27 years since then, I have done the same kind of work. How much will be produced? How much is it worth? How can we produce more? What are strategically the best decisions to majors, independents, individual landowners, governments, and often in the context of litigation. So those 27 years were long enough to see the world change a couple of times. As I sit here today, I see one more tidal sea change coming, and that quite apart from the risk of lower oil prices in the future based on the transition. So let me rewind. When I started in the 90s, it was only a few years after the epic price crash of '86, only a couple of years after the regulatory agencies systematically changed their policies to allow oil companies an indefinite time period to plug their wells rather than requiring them to be plugged in a short time. And when it came to do our reports, I was told we don't need to include asset retirement obligations, AROs. First, the costs are minor. Second, they're probably offset by salvage. And third, it's so far out in the future, it doesn't matter. and that was true in the 90s. Now, I tested the hypothesis, didn't accept what my bosses said, and it was trivial. The impact of AROs on net present value was trivial. Through the 90s, prices were terrible and companies were laying people off. They were not in a position to be interested in proactively plugging their wells. In the early 2000s, mid-2000s, prices of both oil and gas quintupled, which made everything profitable and hugely profitable. And we were followed closely thereon by the shale revolution, which shifted our activities and our development. But by 2014, we had discovered the last shale field. There have been no new shale plays discovered since 2014. In the top 3 oil plays, the majority of the best acreage drilling locations have already been drilled. As several CEOs have said publicly recently, shale oil is not going to come to the rescue of Europe. Shale oil is at its peak or at its plateau. Very little odds that it increases in the future. About the same time that the US shifted its attention to shale drilling, it stopped its drilling of old, anachronistically called conventional fields. Old vertical wells of higher millidarcy fields were fished out, played out. They couldn't compete. Remember, conventional oil production peaked in 1970. We're now 50 years of exploration, production, development, and redevelopment past that peak production. And it was about that same time, around 2010, 2012, that the projects coming across my desk began to change. First time I saw 10 or 15% of the wells in a portfolio idle, I was surprised. Historically, all the wells had been active in producing, but I saw 10 to 15% of the wells sitting there unprofitable to produce. Well, over time, that percentage of idle wells grew. It was 25 and 30 and 30 and 40. And at the same time, as some wells die economically, others were approaching the end point. Now remember, oil and gas production is its highest at the first point of production and diminishes over time. So at the end of its life, a productive well will produce about 1% of the rate it produced originally. It can be a factor of 10, it can be a factor of a couple of hundred, but the margins pinch out. They become very thin. And the production becomes erratic mechanically, and the thin margins become very sensitive to costs, to prices, and to uncertainties in production. So I was seeing a larger and larger percentage of what I would call technically, scientifically crappy assets. Thank you, I appreciate that. I needed that laugh. But last year, a project came across my desk that set a high watermark. So this was a diverse portfolio, a couple thousand wells owned by a private equity company, mature assets, and diverse across 3 states, several dozen fields. So by all the headlines, the labels, the cliches, this should have been a robust portfolio. What I found was that the net present value was approximately equal to a conservative estimate of the asset retirement obligations. I had never seen that before. So I looked at it more closely and I looked at it a different way, and that's where we came up with this idea that I call holdback. It's payout in reverse. How many years of pinching, narrowing production are needed to pay for the asset retirement obligation at the end of life? Now, because it is narrowing, and because we haven't been paying for our costs as we go for 35 years, that holdback period turns out to commonly be the last 10 or 20 years of life. So for years, I had been telling my clients, if you buy it, you better be prepared to bury it. There is no guarantee you will be able to pass it off to someone else. This is the history in the industry. You produce it until it's small for you, narrow margins, and you sell it to a smaller and smaller company. And each time you do, those assets and the liabilities get ring-fenced, packaged, and transferred. As it stands, though, I was surprised to see that it's possible to have a significant net present value, a significant cash flow, and still not have the expectation that you will be able to fund your asset retirement obligations. In this particular company, some of the portfolio company properties would operate for their 40 or 50 years. Most of them were about 25 years long, but this company had less than 5 years when they could take their checks home, and all the rest of their future operations had to be dedicated to covering their plugging liability. And that got me thinking, well, we need a new yardstick. But we also need other people to know. The industry, I can perhaps be forgiven for overlooking this, the whole industry didn't see it coming. You know, operators operate under a moral hazard. There is no incentive to do the right thing, to plug their wells, and no penalty for doing the wrong thing, for not plugging their wells. And so for 35 years, it's been in their financial best interest to reinvest the capital or to give it to their investors. Lenders, similarly motivated to cash checks, the banks have not yet realized that when they go to bankruptcy, the cost of plugging is a business operations cost that supersedes their first lien. The engineers like me, who are supposed to protect against these things, have 2 outs. First, we have relied on the conventional tools. And net present value can trick you, can deceive. Because if I schedule all my AROs at the end, then I have discounted all of my AROs more than I have discounted all of my profits. My profits are uncertain, my AROs are certain, at least certain to exist, but the AROs are less in the net present value than all the profits. The second is that besides relying on net present value, the industry has a little bit of an out by simply excluding those issues from the reports. Standard practice, you can say, well, for clients' instructions, we have excluded consideration, and that's considered full and appropriate disclosure. My client last year decided in the end he did not need my reserve report. Might be surprised to know that. He was kind enough to pay my bill. I appreciate that. The auditors who come along, look over the shoulders of the company's investors, they have their own set of rules about AROs, but those rules are relatively weak, relatively limited, and they depend on net present value also. And the current situation does not fit the strengths of conventional net present value. The credit rating agencies, the ESG rating agencies, to the best as I can tell, and I'm not an expert, but to the best I can tell, they do not consider end-of-life responsibilities at all. They look only at ongoing operations and not at the conclusion of the life. The regulators, the investors depend on all these other guys, and they don't get a clear picture. The regulators are the guys who should have saved the day to begin with. They're the ones who created the problem when they gave the oil and gas industry indefinite time to plug their wells. In the 25 or 30 regulatory regimes that exist in North America, only 2 have begun to address the issue. And to make it worse, many of the agencies have been captured by industry. In Texas, our regulatory agency's chairman is running for re-election right now, and he has said that he sees it as his job to promote the industry and to protect it from undue regulation, which is, of course, not what the statute says. But it's awful hard for these agencies to get the steam. At the other end of the scale, ultimately, the ultimate catch-all should be or can be a civil suit. But civil suits have often not been brought because they're too expensive and time-consuming to prosecute. The landowners don't stand to gain financially, they merely stand to get some repairs made on their properties. That is beginning to change. There's currently a class action lawsuit in West Virginia that could cause that to change. But the whole system is not clear on the implications of failures of net present value. So we've got to do something, and the first thing we've got to do it actually is get a nomenclature, right? We haven't had we don't have a comprehensive and clear taxonomy for the words used to describe asset retirement obligations because we just haven't done it for 35 years. As a starting point, I'd like to propose we need to stop talking about plugging and talk about decommissioning or retirement. The term plugging refers to 1 or maybe 2 of the 8 dimensions of asset retirement. Second, we need to report clearly where we're at. We need to report wells that are idle, wells that are producing less than 2% or 2 barrels a day. And we need to report everything we know about the asset retirement obligations. They put this, and then we need to report holdback, which is the time period at which the costs can be paid. Holdback coverage, which is the ratio of expected revenues to costs. And my personal favorite, discounted holdback coverage. Discount the revenues for risk, don't discount the coverage. But let me put this in context for you. According to Inveris database, there are 2.4 million unplugged wells in the United States right now. Only about 170 of those are shale wells, roughly. 59% of the unplugged wells currently stand idle, unprofitable to produce. Of the producers, a third produce less than 2 barrels a day, or 2 barrels a day equivalent. By comparison, we have established for years the term marginal or stripper well is a well producing less than 15 barrels of oil per day. So if I put all that together, wells that are marginal, micro, idle, or service wells constitute 93% of the unplugged wells in the country. And combined, they contribute 8% of production. On the other hand, the remaining 7% of wells produce 92% of the production. Our industry has bifurcated. The shale producers are flush with cash, but in still a declining geologic condition. The bulk of the wells are producing from plays where there is no hope of another deus ex machina, to come along and create a bulk of cash flow to get them out of the situation, quite apart from an energy transition risk. These companies, 93% of the 2.4 million wells are at the end of their life, and the new phase is to plan for retirement. Now, how to conquer that problem, how to make the policies to enforce that doesn't exacerbate the moral hazard, that's another question. We'll do that another day. But right now, Stephen Greenslade is going to tell you some more about the AROs that we're facing right now.
Okay, this is still on. Fantastic. All right. Well, we're coming towards the end of the day here. I want to try and keep this upbeat, so we won't, I'm just going to read directly off the slides. I'm going to put myself on a timer so I don't go on too long. Okay, fantastic. So today we've talked about energy transition risks facing the oil and gas industry. Mike did a fantastic job. Mark touched on this. I think we're all relatively on the same page. We know that the transition is underway and it has to accelerate. That poses risks. I'm going to try to bridge the gap here between that narrative and what Dwayne has just told us from 25 years of experience in the industry, saying that irrespective of the energy transition, the oil industry is facing a crisis of its own making, and something has to change. The risk is there, but has not been allocated, so people don't know exactly who is going to be tagged with it, although it could potentially be taxpayers, could be investors. The list goes on and on. I'll cover this today, and hopefully I'll keep it relatively high level, and feel free to come and talk to me after the show. It's going to be a good time, cocktails or whatever. Okay, so basic outline, there we go. Skip that. Recap, transitions underway, technology, markets, and policy will accelerate this. So the fossil fuel industry faces retirement as a result of secular trends and disruptive trends based on the energy transition. And the policy levers will push that forward. I already said that. So what is an ARO anyways? Let's all get on the same page with what this is. Dwayne's mentioned this. It's not just plugging, it's remediation, it's reclamation, a host of other things to reset the surface or the sea or wherever the infrastructure is back to its prior state. That's what most laws actually say. To the extent they have reclamation laws, which they're growing in oil-producing states. So these are legal, they're contractual, and/or regulatory obligations. So oftentimes the lease owner, lease owners, surface rights holders, various other stakeholders might have a legal right to have the operator fulfill these obligations. So there's contractual obligations, legal, statutory, et cetera. They're really, the scale of these obligations is quite large and it's not well understood. Let me pull my notes out here so I make sure I'm staying on track here. Right, so AROs they're reported as an addition to corporate debt. They are, according to S&P, one of the largest classes of debt in the industry, although that's a bit of an old report because of very, very loose monetary policy. Companies have taken on a bunch more just standard debt, which obviously puts them in a tough space right now as interest rates rise. That's a whole nother story. Historically, since these obligations have been deferred to the extent allowed by law and often beyond, the number of marginally productive and inactive wells has ballooned to an enormous size, as mentioned by Dwayne. As Dwayne covered in his talk, even without considering the energy transition, the problem of marginally productive wells poses a massive risk to the industry. And in a very basic sense, the industry faces retirement due to field decline and a large outstanding bill for AROs, in addition to these secular trends that we noted and the disruptive trends of the energy transition. So there's multiple different and compounding risks that are encroaching upon the industry right now. Okay, as we've mentioned, 90% of these reserves that will produce the cash flows to settle these AROs must stay in the ground. So we understand that that's the case. Companies are not required by law to save for asset retirement, and so they don't. AROs are assumed generally to be settled out of the operational cash flows, operational revenues from the companies. And as we know, the portfolio of liabilities is growing, cash flows are expected to decline over time. And so we can only assume that unless there's a dramatic change in the current liability regime and funding structure, that the stranded assets are what's really what we hope to pay for these obligations, which obviously is an untenable situation. Now, what is the actual cost here? So Carbon Tracker has estimated that onshore alone, downhole plugging costs will be around $280 billion. This doesn't cover reclamation, doesn't cover remediation, and quite frankly, this is a modeled estimate. It's proven to come relatively close to the real numbers we're seeing, but generally speaking, on the ground, we're actually seeing numbers coming in even higher than this estimate. So we can expect this to rise. So we got $1 trillion of potentially stranded CapEx that Mike said. We've got probably easily $500 billion in onshore plugging costs, and then trillions in global retirement liabilities that all have to come from a declining cash flow stream over the next few decades as the energy transition progresses. So how do we grapple with this? Well, there is a regulatory response underway. As Dwayne mentioned, still to this day, many regulators consider themselves, they consider as part of their obligation to the industry is to foster energy development. And in some statutes, there's even language that says, they're supposed to maximize the ultimate recovery for the state and for taxpayers in the state. Okay, all well and good, except for that shouldn't come as an alternative to their other statutory obligations, which is to protect public health and the environment and ensure that the laws are followed within the state. And so, yeah, I mean, this latter aspect of ensuring companies are responsible actors within state boundaries has become more important over time, and there's a rapidly growing awareness that orphan wells are a huge issue. And we are starting to see some actions along these lines happening amongst regulators. So there's increasing financial assurance that just happened in Colorado, imposing trailing and joint and several liability, requiring parent guarantees. Let's go over a few recent examples just to show that this is a material issue for investors and for companies. Colorado just unveiled a new financial assurance regulations that will dramatically increase the cost to companies, especially companies with very low marginal production. Do we think the new rules are sufficient or the end of the road for regulatory reform? Not by a long shot. However, this is a step in the right direction. US federal regulators are considering changing their rules on financial assurance, both onshore and offshore. In Australia, recently, they imposed a levy on industry that could cost Chevron hundreds of millions of dollars to decommission assets that they have never owned or operated. And we will continue to see this kind of activity going on, particularly outside the United States. In California, after the Veneco bankruptcy, Exxon, who was a prior owner of Platform Holly, was on the hook for about $350 million in decommissioning costs for one platform, and not even all the wells on that platform. So this just goes to show these are really substantial costs, and they can manifest on the balance sheet in unexpected ways, especially as the energy transition progresses. And then also recently, another major activity, BP just sold all their assets in Alaska to a company called Hillcorp. As a condition of that transfer, Alaska regulators required the parent company, BP PLC, to maintain liability for all the decommissioning obligations there. So it's going to become harder and harder over time for companies to escape these liabilities. However, they're not doing a good job of reporting them, tracking them, and planning to resolve these obligations. Okay, so this brings me to a key aspect of this presentation, ARO acceleration. These regulatory responses, though often piecemeal and incremental, they fit into this, what could be called an inevitable policy response in response to orphan wells. And they're also connected to this complex web of feedback loops that is associated with these energy transition risks that Mike discussed earlier today. ARO acceleration is a critical transition risk for oil industry because it signals a point when incumbency advantage turns into an incumbency burden. It's also critical because it is directly related to other processes and risks associated with the energy transition. Well, I already said that. And And quite frankly, another huge piece of the problem here is that the risks have not been allocated. So nobody exactly knows where they're going to fall when the music stops. Okay, so let's look at kind of the basics of ARO acceleration, just taking one piece here, that's AROs. So lower long-term oil prices bring forward AROs. That unwinds the discount on the balance sheet. It lowers operating revenues, so you have increased operating costs, increased marginal cost of production, and you're increasing balance sheet liabilities all at the same time. And this is just when the reserves are being revalued down alongside those lower oil prices. So we're seeing compounding issues. Lower asset value, greater liability value equals destruction of shareholder value. So that's obviously should be very interesting to investors. And then this cycle itself fits into this larger cycle, which is the energy transition. We've already discussed on this, so we'll just skip through here. So let's take a look at a real world example here. Companies rarely disclose their actual undiscounted global ARO. BP, as far as I know, is the first company that's ever done this. Maybe I could be wrong, Rob might correct me later, but this is the first instance that I've seen it. They estimated $23 billion in undiscounted decommissioning provisions globally in their 2021 annual report. So I just checked this morning, it's about 24% of their current market capitalization. So lower long-term prices are going to lower their market cap, and they're going to bring forward those cash costs. Now, their current balance sheet ARO is around 16 billion. So, I mean, they're probably not discounting that as much as a lot of companies are, but that 16 billion will rise toward that 23 billion level, and it could exceed it if their estimates are low. So what does all this mean? I mean, we've got, the cynical among us might say, well, you know, regulators are gonna let it happen, it's all just gonna go to the taxpayers. Okay, that's a possible outcome, and it is happening right now, but it's not all gonna happen at once. So what can we expect to happen through this process? Okay, so there's the bankruptcy and bailout option, where, and we're already seeing this, cyclical downturns are sending more and more small companies belly up. And there's fewer, you know, especially for some of these portfolios that have very, very low production, nobody even wants to come in and pick through what's left. And so that all just goes to orphan well programs. We're seeing orphan well programs grow. Like the well numbers are growing, and you know some of that's going to come down temporarily as the federal funding comes in. That's real bailout money there, but it doesn't solve the long-term issue, right? Another thing that kind of goes in tandem with this bankruptcy bailout issue is ARO evasion. And companies are getting more and more sophisticated in how they do this in terms of spinning off these liabilities, selling them, transferring them, or otherwise just deferring them indefinitely. And you know, I think a major risk right now is that some companies are trying to put forth novel business models that seem like, oh, they're going to solve this ARO problem. But I think until we have a real solution on the ground, we have to assume status quo. And quite frankly, the vast majority of the wells that exist in the United States are decades old, and they have no future life in any other industry. They just need to be plugged. And then the last opportunity here, which really is what we're going to aim for, is that increasingly over time, responsible parties will pay. That doesn't necessarily mean the current owner, but hopefully responsible parties will pay. So we have these recent examples in Australia and California, but also I just want to note that as it stands currently in most oil producing states, orphan well programs are funded by an industry levy. Now, if these orphan well portfolios start to grow, states will have to raise the levy in order to bring down the total tally, and that's going to impose an additional cost on industry. So, investors, risks and roles. Where do investors stand in all this? What should you know? So, I mean, this is not necessarily an all-inclusive run-through of how investors should engage with this issue, but broadly, I kind of separated it out into two categories here. We've got institutional investors, value investors, index investors, buy-side, researchers, etc. So it's really critical to understand, engage, internalize, and if necessary, reallocate. And so the questions here for investors are, how are companies reporting these AROs? Are they disclosing their critical accounting estimates that go into that? Are they disclosing the time frame over which they'll be resolving these AROs? We can talk more after if you want to know more specific details about this, but it's a critical issue because investors, you can't look at a 10K and look at the reported ARO and really, you can't deduce any real meaningful decision useful information from it as it currently stands. Valuation implications. So if AROs have just been excluded from valuations, what happens when you bring those back into the model? What are the potential impacts if and when regulatory agencies take more stringent action to ensure taxpayers don't end up on the hook? And then tail risks. You know, we had Natalie say earlier, this is a black swan situation here. What happens when the dynamics of the energy transition meet the dynamics of field decline in a catastrophic way with like a long, you know, like a period of multiple years of very, very low oil prices? What does that mean for the companies in which you're invested? And then certainly it's no small matter of ESG risk here. You know, no pension fund wants to be seen, or I hope there's no pension fund out there that really wants to be seen investing in a company that is actively planning not to pay their legal obligations to settle their AROs. And there's really no way of knowing that unless you start to engage with companies, engage with boards, engage with the directors, and see what is their plan for dealing with this. But you know, it's not just folks who are interested in ESG or long-term investment horizons who should be concerned about this. Even if you're a private equity guy who just wants to get some nice cash yield off of a short cycle investment, you know, you still need to consider what the valuation implications are here. What types of regulatory risk exposure, you know, could impact your investment? What if you can't sell that again? You know, what if you have a 10-year investment cycle and you can't, nobody wants to buy it at the end of 10 years, and then you're stuck with the liability. And then other types of liability issues. You know, if you're taking an active role in the management of that company, are you personally liable to resolve the obligation? Potentially. And then timing of market and policy shifts. This really brings us into hopefully what I can kind of bridge all the gap, or you know, bridge all the pieces that we've discussed today, in terms of like, it's really critical to start modeling this so we can actually time and be thoughtful about managing the decline of the oil industry. So let's, oh yeah, but before we get into that, let's just say regulators. Come on, there's a huge role for regulators here in doing your job and ensuring that companies are reporting the right information as financial regulators, demanding better disclosures, because current accounting rules may be sufficient in this regard, but companies aren't being raked over the coals. They're not being grilled for giving really bad ARO accounts, and we need to ramp that up and make sure the market's informed. For oil and gas regulators, we have to ensure that the obligations are internalized, which the best way to do that is to make companies, you know, to require full cost financial assurance. Make sure the companies pay now or pay over the economic life of the well, rather than waiting till all the cash is gone and saying, hey, it's time to plug it. And now's the best time to act because cash is flowing, right? Okay, so just to touch a little bit more on what Dwayne mentioned, Dwayne came up with this great idea, holdback. Rather than looking at the net present value of assets, let's look at the actual undiscounted cash flow of assets in relation to the asset retirement obligation. What happens? So here's a little diagram of what he showed earlier. Payout in reverse here, holdback. We don't have to dwell too long on this. But you know, I just want to say that holdback is a concept as much as it is a methodology, and the entire industry can be viewed through this lens. An inflection point approaches, beyond which the industry will no longer be able to afford to pay off all of its decommissioning obligations. And the only way to really have a rational sense of how and when that's going to happen is to start integrating these types of analyses into your models. And quite frankly, because cash flow modeling is such a bread and butter aspect of financial analysis, it can be incorporated into all different types of models, including scenario analysis. So if you're running sensitivity tests based on different energy transition scenarios, you can include holdback in here to see, you know, okay, if our long-term price assumption is $40 a barrel, at what point is this company insolvent with respect to its AROs? These are critical questions to answer. And as an investor, you should be asking the board, asking the directors, do they know the answer to that question? And how are they planning for these different contingencies? So there's a lot of different uses for holdback. It's really just a way of looking at cash flow and understanding that end-of-life obligations are real. There's no reason to discount them because once the well is drilled, the obligation exists. It's not something that people can imagine away. A bankruptcy court can't make it go away. They might be able to send it off to the state, but that means that the state and or the landowner is the one who's left with the liability. And so I'll close it up here, and we'll get off to the discussion here. But just a basic recap here, we've got all sorts of multiple and compounding risks. And because the scale of ARO risk is very large, and because these have not been appropriately modeled and allocated, it could manifest in unpredictable ways, which could have an impact on investors, taxpayers, and any number of stakeholders in the oil and gas value chain. So that's it for me today. Thank you very much for your attention.
Is it working? Yes. Okay. Hey, everybody. My name's Nick Kuznets. I'm a reporter with Inside Climate News. And so now we're going to have just a little bit of a discussion about, more of what Dwayne and Stephen were talking about, try to unpack some of these topics a little more. And we'll also save some time for questions from all of you. So, if you think of any, we should have a few minutes at the end for that. So thank you both for that. And yeah, I'd like to kind of just delve a little more into some of this. And for starters, Stephen, well, you both spoke to this question a little bit, but I'm wondering if you can just talk a little more about, like, do we have a handle on what the costs and risks out there are? I mean, you had the estimate of the plugging costs, but at my sense, it's bigger than that. I mean, both in the sense that that's only plugging, but it's not just the US. So I'd love it if you can each just talk a little bit more about like what we do or don't know about what's out there looming.
Okay, it's a great question. So I would say that the biggest challenge to answering this is a lack of good data right now. Nobody knows better the costs than the industry themselves, and they're staying pretty tight-lipped about it. Now, to the extent that we do have access to real invoices for plugging costs, as there's a recent batch out of North Dakota that we did an analysis on, we're seeing those numbers come in even higher than our cost estimate, which is the highest modeled cost estimate that we have found so far. So we can only assume right now that the full cost is going to be significantly higher than the 280 billion because, again, that's just downhole cost. Now, when you expand that out to the entire globe, I mean, I would be remiss to say that it's definitely going to be $3.5 trillion. I can't look into a crystal ball and say that. But what I can say is that it's a much higher than most people assume. The risks are material to these companies, and it's really a critical piece of the equation is to get better disclosures on this so we can have a better sense of what the actual costs are going to be.
Yeah, unfortunately, Nick, and thank you for the question. We don't have a good database, good public disclosure we can draw on to look at. What we do know is that the companies that have talked about their obligations have in recent years, in the cases I've studied, dramatically increased their estimates of future costs. We know that the cost of plugging is the downhole cost, but we also have surface cost of removal, surface cost of remediation. Then we have unplanned costs due to mechanical complications. All of the uncertainty in a cost estimate is to the high side, and that can be very meaningful. And then, of course, we have long-term tail obligations. I'll also say that all of the pressure on the costs of plugging and other retirement issues is upward. There are no macro trends to provide pressure to reduce costs. Someone asked the other day whether technology was going to make it cheaper, and the short answer is no. There is no active research on plugging technologies, and as it stands, the technique we use is 50 years old, and it is very cheap to execute. Very simple. There's no increased science. We're putting cement in a hole in the ground. That's the technique. So all the pressure all of the risk is to the high side.
And so what happens, like, what does it look like if regulators or investors, if don't get a handle and start to kind of change some of how this is handled now? You know, what does that start to look like in the future?
You know, I would argue we don't have to look to the future, really. We're seeing it happen now. So because of the fact that financial assurance rules are insufficient and plugging requirements allow indefinite deferment, we see, you know, these bodies of wells growing that have really no marginal value. And when there's some sort of cyclical downturn, the companies just walk away. And so all we can expect without a change in the fundamental dynamics here is for that to continue and to get worse as you know, as different exogenous pressures from the energy transition drive down prices over the long term.
So was that? Yeah. Okay, good deal. Thank you, Nick. The holes that we put in the ground are going to be there until the sun explodes. I take it back. North America will collide with Africa in about 200 million years. So at that point, the rock will crush the holes. Up until then, we have plugs within the hole. So there are two things that are going to happen. One is those will fail. Or if there are no plugs, we'll see surface blowouts. We've had two dramatic cases this year in Texas, made the statewide news and I think some national news as well, about blowouts that have occurred in wells that were not properly plugged or were not plugged at all. But then the cleanup costs goes back to the taxpayer. They end up being a charge that we have to pay for. Right now, Texas has no state income tax. We rely on severance tax from oil and gas. The unfunded, in Texas, the unfunded downhole part of the cost is equal to the Texas state budget for the year. So we start losing revenue and at the same time have to increase the public costs, and we could look at the change like the addition of a state income tax in Texas.
Yeah, I mean, you were saying that this is happening already, and I remember when prices crashed in 2020, as the whole world went under lockdowns, and a lot of smaller companies were declaring bankruptcies, and there was kind of this swelling of orphan well counts in some states, and people then were talking about like, oh, this is, you know, what you know, the transition, a messy transition might look like. I'm wondering, like, looking back, you know, was that kind of any sort of a preview, or were there any lessons from that for this, you know, going forward?
Well, I mean, one lesson that I took away from is that well, if you look at some companies in particular, a great example would be Diversified Energy. They stayed afloat essentially because of federal intervention during COVID. I mean, so much subsidy money and tax benefits were offered, particularly to owners of low-producing wells. And this is true outside of crisis times, but it was especially true during the COVID crisis, oil price collapse. Regulators at the state and federal level were jumping in with buckets of money to help people out. We're lucky it wasn't a worse situation then, but at the time the goal was just to support local industries, you know, by heck or high water. And so looking ahead, the question for me is, you know, what happens next? You know, what happens next time, really? You know, are we going to step in with more federal money to let this problem be kicked down the road even further? Or will we take some sort of action in the meantime to hopefully lessen the blow next time there's a really major price collapse?
Yeah, and I'll reiterate, Stephen, there really is going to be a next time. There was a bumper sticker popular in Midland in the 1980s, and it's come back intermittently. It says, "Please God, give me just one more boom. I promise not to waste it." We've promised not to waste the last several. But the industry has always been and will continue to be cyclical. We will have times like the present where we're flush and there will be busts. My personal opinion is that as we go through peak oil demand, that we will see an extended bust. And that will pinch out a bunch of these producers, the hundreds of thousands of wells in the US that are just barely holding on with their fingernails.
Yeah. Well, we've been talking primarily about like financial costs and risk to investors and like public purse in a sense, but of course these have a huge environmental cost. You know, like I've done reporting in North Dakota where there are farmers with wells from previous booms like of the 50s, and they just have like an acre of their land that for, you know, a generation they haven't been able to use here because it's contaminated with salt water. And there's the geyser you mentioned in Texas earlier this year, but there can be groundwater contamination from old plug wells. And of course there's methane leaks. And I think, you know, there's not necessarily a great handle on how much methane is leaking from wells because it can range so much. So I was wondering if you can each speak a little bit about like the environmental risks here, and again, sort of what we do know, what we don't know.
Yeah, I mean, methane's obviously a critical issue that's gaining a lot of traction and attention around the world right now, including at least nominally within the oil and gas industry, because it's an extremely potent warming gas. But these wells also have a lot of localized pollution issues. Hydrogen sulfide is a deadly gas that can leak from various wells. Groundwater contamination, you know, brine. Brine's a huge issue. You know, I was recently in North Dakota as well, speaking with ranchers and around wells there, and especially in arid parts of the state. If there's any kind of brine contamination, they just have dead zones on their farmland, essentially. So the well might be gone, but if it hasn't been properly reclaimed, then they've lost a huge section of their land, essentially, for economic purposes. You know, not to mention, I mean, in California right now, they're grappling with air pollution issues around oil and gas development, and particularly in Los Angeles and Central Valley area. So, I mean, the list really goes on and on and on. You know, these wells, they're not clean, and especially when you're dealing with decades-old wells that were drilled with older technology and they haven't been well maintained, or even if they have, they're just so old, things start to break down, they start to leak, and you know, just you can look at, I mean, just stochastically, like there's if you leave 100 wells out in a field, some of them are going to spring some leaks over time, you know, and that's what we're dealing with, except for at a huge scale across the United States right now.
Yeah, we certainly don't have a good enough handle on the emissions from wells that are leaking. We do know that it does occur, and we know that there's no benefit to anyone when it happens. The industry also has a problem with venting and flaring. And those are, I think, the top three issues we have to address, the first in the queue. Industry is actively talking about working on solutions to reduce their, to monitor and then shut off the fugitive emissions. Lots of growth in that part of the services, happy to say. That trajectory I see continuing. The difference is that the venting tends to come from a different class of operator, and the wellhead leaks from idle wells come from a different class of operator. We're going to take a different solution to eliminate those parts of the issue.
You know, I was interested, Stephen, in your talk, you mentioned kind of briefly this example of Australia and what happened with Chevron, and then you mentioned another, like an offshore rig in California. I was wondering if you could talk a little bit more about either of those examples, or both, just kind of tell us what happened.
Yeah, sure. Those are indicative of a different liability regime that exists in many places offshore, which is called trailing joint and several liability. And the essence of that is, if I drill a well, you know, make some money off of it for a while and sell it to somebody else, and then they go bankrupt and leave the well to the government, then the regulator can come to me and say, hey, you used to own this, now it's your problem. That's not the end all be all. It's not the best possible solution to this issue, but it is far better. And in Australia, they went an extra step there. You know, they flexed their regulatory authority to say it's not just previous owners, but it's the industry as a whole that's responsible here. And you know, I think there's a lot of sense to that method. because major drillers today, for the most part, have been around for decades. No one has benefited more from essentially the free environmental credit that states are issuing when they're not requiring financial assurance than the biggest operators today. So they've gotten money hand over fist from not having to deal with this responsibly, and they've sent a lot of these wells down the food chain. Well, it used to be industry, it still is industry standard practice, but nonetheless, they're the folks who've reaped the benefit to the greatest extent. And so from a basic equity standpoint, it makes sense that if and when this transition progresses, and if and when these risks start to manifest more significantly, people who are within the industry that still have the cash to deal with their own legacy issues should be brought to the table to deal with that.
Yeah, I mean, like the cynic in me thinks that for all of those unplugged wells that Dwayne was mentioning before, and for even for the shale wells that are being drilled today or were drilled last year and are going to soon be not producing that much, for anything that's already been done, that cost is just the companies will find a way to pass it off, right? And that it'll eventually end up on the taxpayer, basically. So is that true, or is there anything either in place now, or are there things that could be put in place that would not just affect what's drilled after that new regulation, but everything we already have?
Can I take that one, Stephen? Yeah. So the industry, the oil and gas industry, took notice of ESG issues because capital markets made them. The regulators did not, or the regulators have lagged. I believe that the financial markets can exert enough pressure to change behaviors. And there are things that companies can do. For example, Stephen was telling me earlier about a recent transaction where the seller required a full indemnity bond from the purchaser. Those sorts of, I have seen that, but only occasionally. Those sorts of actions will cause a change in the market. It'll make sure the money is set aside. Ideally, the regulators would do something. The risk is when the regulators take an action, they exacerbate the moral hazard. The risk is they make it more attractive for a company to go ahead and file bankruptcy rather than solve the problem themselves. We'll keep looking for solutions. I do think the financial markets, capital markets, have an important role to play.
Faith in markets over here, are you?
And I mentioned there are actions that regulators are taking, and I think that we will. My expectation is that will progress further, because as much as regulators are charged with fostering industry, they also don't want to be blamed for taxpayers being on the hook to plug 10,000 wells. And so the regulator sits in a precarious position, but I think we can expect that they will continually take incremental steps to keep these costs from going to taxpayers, which also reinforces this internalization into the market. However, the question is, are they acting fast enough? Are the moves that they're making sufficient? Are they good policy choices, or are they creating unintended consequences, like rather not really dealing with the underlying issue and making it more attractive for companies to bail on their obligations? So these are really challenging questions to answer because we're so far down the road, as Dwayne discussed in his talk. But I believe that there are solutions available, at least to dramatically lower the risk to taxpayers and to increasingly shift that burden onto the responsible industry. But it does require thought, it requires foresight, it requires careful analysis, and hopefully we can help to encourage regulators and other responsible parties to do that due diligence.
Well, and we also need data. We need information. We need companies to talk about what it costs and what the status of their projects. Right now, that's still not something we can get a real good, clear picture of.
Now, are there either of you point to any success stories or good examples where the right things are happening?
In terms of
either with a jurisdiction, where regulators have done the right thing, or a particular company, or where the kinds of things that you're asking for are actually in place?
Well, Colorado has increased their financial assurance. Alberta has tried to. And sometimes a major operator will go through a field and plug them all out before they go to sell it. And there are people, I have one client in particular who keeps a very clean sheet. He has probably 5% of his wells that are idle. There are some people doing the right thing.
Yeah, I mean, I think there's absolutely, you can always expect that there will be some good faith operators out there. I think that generally until the incentive structures change, we can't expect that that's going to be the majority of companies. And there are these incremental changes that are positive, but to get to the core of your question, if I can, put it in black and white, is anyone doing enough? The answer is clearly no. And in Colorado, they just changed their financial assurance rules, and there's going to be some positive developments out of that. But I did an analysis on the whole system, and it doesn't look great, honestly. And I think really, I continually advocate for there to be more of this managed decline mindset. So rather than thinking of these companies as discrete entities that are all responsible just for their pocket of wells, because obviously, so many wells have been packaged and spun off intentionally to avoid the ARO. We really need to be looking more at an industry-wide solution to the problem.
Did you want to add something for it? No.
Thank you, no.
Yeah. Okay.
That was good.
So it strikes me that, like, in part, it seems like this problem emerged because people were saying, like, this is, we don't need to think about this now. It's not, not a big present problem. But of course now, if you look at like oil companies in the oil industry, they're under immense pressure around climate change. Leaving this aside, and there's like what Mike was talking about earlier today, and they're just facing pressures, sort of existential risk, right? The investor community is everyone's facing these huge pressures and questions. And so how now do you take it and say, now you do, now you need to pay attention to this thing that you haven't been paying attention to, when they're facing these other huge risks? How do you kind of keep it present in the mind of investors and companies?
Billboards. It's a good question, Nick, and I don't know the answer. When prices increased the way they did, it gave a whole new lease on life. When shale came along, it gave oil companies as a whole new life. And the underlying inherent immutable reduction of production that happens in every oil field became invisible. I don't know how to make it more visible other than the kinds of events we're doing right now.
And I think investors who are interested in this really should be pressing boards and directors on these issues, because it's really no excuse for a CEO to come and say, sorry, like, I know this is an issue, but we got all these other issues we're dealing with. Because the fundamental problem of AROs has not changed from yesterday to today. It's been the same obligation for decades. And so to disclose to investors, oh, we just assumed we weren't going to have to do that, it's not an appropriate answer. Now, I'm not saying that's not the case in some instances, but for investors, going forward, the question should be, how are you addressing this now? Like, there is no change in the underlying dynamics, but we do see going ahead that the market is changing. How are you dealing with this situation, noting that this risk gears into all these other risks, because it's not separate, right? The ARO risk and energy transition risk, they're not two different things that directors should be paying attention to separately. They're one problem that they should be addressing as part of their forward planning.
Well, I wanted to open it up to see if anyone has any questions. Do you need a microphone back there?
Hello, thanks for a great presentation. Bryn O'Brien from ACCR. Australian research and shareholder advocacy organisation. We, in our shareholder advocacy activities, put a shareholder resolution to a couple of Australian companies earlier this year, calling on them to disclose their very basic information about their decommissioning liabilities. So the companies are Woodside and Santos. We got roughly only 11 or 12% of shareholders were interested in that resolution and voted in favour of it. BlackRock came out with a voting bulletin saying that it was too prescriptive. So this is, again, just a non-binding advisory disclosure resolution. I totally agree with you, Stephen, that, you know, that this is these are questions that investors need to have answered now. And if so, why are they not taking the opportunity to ask the question or to just seek the information? There's a real disconnect there.
I don't know. It sounds like we need to talk to BlackRock about this, basically.
There's a paradigm problem here. Most people don't recognize, one, that an existing asset diminishes its productivity, its profitability. They don't recognize, two, that we've been saving up the costs, we haven't been paying as we go, and they don't recognize that the geology in the US is fished out. So there continues to be this belief, which has been reinforced with behaviors in the last 20 years, that this can go on forever. There's a Texas singer-songwriter whose name's Robert O'Keefe, publishes a fantastic song called "The Road Goes On Forever and the Party Never Ends." And great song. At the end of the song, one guy's going to the electric chair because they partied too hard. It's a misconception, but it's a persistent paradigm that we can keep this going.
Well, before we move on, I just want to say it's such a critical issue, and I wish I had a better answer for you. But please, let's talk about this. Let's keep the conversation going, because to me, it's absurd. Why wouldn't large stakeholders want to know accounting estimates that companies should be reporting anyways? And frankly, BlackRock should be answering that question.
Wayne, Stephen, thanks for the excellent presentation and follow-up. I'm interested in following on the data question you raised. It sounds like this is an asymmetry of information problem. Is the data problem the number of wells, the condition of the wells, or the cost of the wells? And is there any application of new technology such as remote sensing or satellite viewing that would help bridge the data gap so the market can begin to see and price this liability?
Well, the first answer is yes to all three. Data gaps are huge. In some states, it's not clear which wells are plugged and which ones aren't. There's virtually no information about the quality of the subsurface infrastructure of wells. Now, there are strides being made in terms of leak detection, but that tends to be aerosol leaks, methane gas. It doesn't tell you if there's something leaking into groundwater. And these are, those are nitty-gritty regulatory issues, where regulators really should be following up with companies and requiring mechanical integrity tests and other things to prevent undue pollution. So I guess a big piece of the equation here is ensuring that regulators are requiring data to be provided, and that they're gathering the right data, and that they're disclosing that data in a way that's actually accessible to the public. New technologies are definitely helping in terms of getting at the methane issue. And there's a lot of investment right now in the philanthropic world to get at this question. That's fantastic. Does it fundamentally solve the problem that you're talking about informational asymmetry? No, it doesn't. And as to the cost point, we've continually advocated for regulators to collect cost information from companies. But only the federal government does that, and only offshore currently. And that's why the federal government has a whole database that shows you can go on and look at a platform and see what the expected cost to decommission that platform is. That doesn't exist anywhere else.
Yeah, and there's no getting around the issue of costs are a private matter, and their companies are not in the habit of disclosing what their costs are. Their public databases exist for production. I can see which wells are not producing, but there's no public data that'll tell me which ones have holes in casing. The regulatory agencies really should be collecting information on failures of well integrity onshore. We're not doing that. Even if companies would take the step of breaking down more detail in their financial disclosures, would be way down the road. But getting real out-of-pocket cost information is a hard problem.
Thanks. I agree. This was a really interesting presentation. Eugene Montoya from Wells Fargo. My job is actually to measure the oil and gas emissions of our clients, and bring those back to financial terms. So understanding how we link to those indirect emissions, which we don't have control over, but we have to assess them from a financial impact perspective, which could be revenue, could be cost, could be capital. It's a lot of the same thinking that I'm noticing with this topic of AROs and also abandoned mine lands, especially in the United States, where there's quite a lot of communities that have been affected by the transition away from minerals. And in those transitions, we find that there are opportunities to, in some cases, adapt the land and recover it and turn it back into useful land, or potentially to seal the mine, but bring back some kind of economic activity to that area. In doing so, this meets a lot of patient capital interest on just transition, but it also brings economic value back to the actual asset. So my question is about the oil and gas industry, much more challenging than I think even some of the abandoned mine lands we've been looking at, because there is a geological aspect of sealing the well, and there's another interest that, on the solution side. If this money has been procured or it is in proxy, can it be spent on decarbonization? Can we actually use the existing infrastructure to return carbon stocks back to, or flows back into stocks? And the reason I ask is because we're all on the precipice of a very large carbon market push in the financial services industry. So if this was a potential solution to give second life to these, otherwise terminable assets, is it geologically sound? So I'd love to hear what Dwayne's perspective is on that. And B, is it something that we could financialize through the ARO as an investment?
I've been some cycles on that, Gene. I do think it's possible that voluntary markets will bring money to the plugging industry. I don't want that to turn into another moral hazard where the companies are in the business of keeping wells alive too long so they can collect payments from other people to plug them. There will be a place for that, and a valuable place. I'm not sure how to scale it. In terms of making productive use of the sites, maybe. An oil and gas operation site is generally an acre or a couple, and it generally has some sort of rock pad so that it can accommodate heavy equipment. There are also central facilities where there have been a good deal of fluids come through and occasionally leaks. So if you plug a well and you cut the wellhead off and seal it 6 feet below surface, now you have an acre or two of rock that may or may not have viable soil underneath it. We could plant trees around the edges. We could set up bat boxes. We could set up solar panels or windmills, but it's a relatively small footprint. It's not a big installation. I haven't found a good solution to repurpose those. We'll keep looking.
And I'll just add a little bit onto this. It's a fascinating question. I think it's a point of inquiry for a lot of people right now, because, if you see $1 trillion problem, some people might see $1 trillion in potential revenues, right? Now, fundamentally, I think we're dealing with millions of wells with unique geology spread out across various regions across the United States. is there going to be one solution that comes in and solves the asset retirement problem for industry? That's outlandish to expect that's possible or reasonable in any time frame that's relevant to the current existing asset retirement obligations. So when we think about alternative pathways at end of life, we should be really cognizant of the fact that untested technology should be assumed untested and unproven until it yields returns, and ultimately it shouldn't change the fundamental calculus, right? It costs X number of dollars to plug the well, or at least there's an obligation at the end of life. If I want to take an old well and convert it to carbon storage, almost certainly I'm going to have to go back into the hole and do some sort of mechanical operations. I might have to change the casing, et cetera, might have to deepen the well to a strata that's more sufficient for this particular use. But whatever company that's taking that on, they should be aware of this obligation, and they should be pricing that into whatever value they place on this potential investment, rather than just assuming that this is another way for us to continually defer these obligations into infinity. And as I said, I mean, some of these obligations are mature today. If a well's not producing, if it hasn't been producing for 5 years, that well should be plugged today. Is there future economic opportunity? Maybe, maybe not. But if the responsible party's there and the well should be plugged, there's no reason for us as the general public, as taxpayers, as investors, to assume that some future miracle is going to come along, especially considering the fact that we're dealing with distributed infrastructure that may or may not be suitable for any particular future economic use. So all these things have to be part of the calculus here. I don't know if that's helpful in considering this.
Yeah, actually, just to follow up on that. Also, sorry I came in late, but I was actually coming from the Sustainable One conference. Thank you. My name is William Jones. I'm an investment analyst with GQG Partners. We're a long-only public equity firm. And I was actually going to follow up on the storage question because I was curious if you've seen any viable instances of people using CCS technology to mitigate those potential, well, not just emissions, but the actual occurrence of the loss.
The actual occurrence of
what?
Like
realized loss on their balance sheet, like from the AROs.
I haven't seen that. The regulations for CCS storage are not conducive to the use of old wells. We can use it under looser regulations for EOR, enhanced oil recovery. But the amount of supply that fits that is relatively limited, and the number of places where we can deploy it is relatively limited. Now, if we could change the regulations that would allow us to store CCS in oil reservoirs, gas reservoirs that are depleted, and have a bunch of perforations, a bunch of penetrations from existing wells, we would increase the risk that these CO2 escapes again. It might be a good solution. It might be a practical solution, but that's not a viable solution right now.
Hi, Tanya Coten, and inevitable policy response, although from what I'm hearing, this might not be inevitable, the policy we're talking about. But my question is, on the regulatory front, so it sounds like there's no federal regulations on this, and it sounds like the state regulations are also kind of screwed up, and it sounds like it doesn't fall under the Superfund law, and it doesn't fall under EPA's Clean Air law. And so where are the environmental activists? Where are the community organizers to spread the word that these are a bunch of cancer alleys all around America, to add to the reputation risk that oil companies have and to kind of elevate the issue? Like, where's Bill McKibben on this? Where's Amy Lovins on this? Where's WWF and Earth Justice and NRDC? So is there anybody other than Carbon Tracker? Not that you don't have a powerful voice, you certainly do, but anybody else who's out there kind of screaming about this?
It's a great question, and I would say probably the organizations who are most influential and most active on this are generally localized, and oftentimes it's landowner groups. In West Virginia and North Dakota, there's pretty powerful landowner groups that are really interested in improving regulations here because they're the folks who are impacted by this. you know, I think if I can editorialize a little bit, you know, oil and gas operations tend to happen in relatively far-flung locations where we're dealing with economically depressed communities that generally don't get the spotlight very often. And when they do, it's usually not a good one. And so it's not like a sexy topic, I think, for a lot of folks. They're not saving whales. These are legacy communities that have been impacted by the energy industry for decades, and oftentimes are critically reliant on the energy industry today just to maintain their local industry. However, that doesn't mean that folks living in those places don't want these issues to be resolved and don't want a viable alternative to the oil industry in the future. So, you know, are there organizations working? Absolutely, and some major groups have taken this up more broadly. You know, we can talk after if we want to actually hear some names, but yeah, I would say in terms of our discussions with local groups, we find the most traction with actual landowner organizations that are directly impacted by this stuff.
Landowners often also have a bit of a conflict in that their local economy is driven by the oil and gas that they're trying to pressure to do something right. I will say, though, that in this spring's primary for the Texas Railroad Commission race, the incumbent was challenged by several oil industry insiders who were adamant about exactly this issue. He ended up winning the primary in a runoff, but in the first count, he only got 48% of the vote. These other industry insiders running against him primarily on this issue prevailed in total in the first primary. So there is pressure coming inside the industry as well to do something about this.
Sorry, and this is a very different question. So, you know, you said BlackRock should know about this and should be acting differently. So I guess my question is, have you spoken to BlackRock or any other managers? Natalie was back here. That's a better target, for, you know, in terms of an active manager. You're a better target. Is a better target. Active managers are. So how aware are they? You know, have you done your kind of roadshow, one-on-one meetings with oil and gas analysts on both buy and sell side?
Henrik, it sounds like you need to put me on the road, so let's.
I mean, I'll put you on the road.
So our investor outreach team is fantastic, and Henrik is here. Simon's in London, I believe, right now. So they're the folks who are primarily out there. They can tell you more about who they're speaking with directly. But this is a growing issue for us. This isn't full fruition you're seeing here. So there's still doors we need to knock on, and traction that we need to build. But so far, I mean, it seems like a lot of people are interested, and I think the argument's so clear for me, right? Like, companies should be disclosing this information already. Why not just ask them to do what they're supposed to be doing?
Just yesterday, I was reading the BP annual report, and not only did they make those disclosures, they described that this was a particular emphasis and extended topic of discussion among management and auditors. BP may be ahead of the curve, but they were giving a hard look at this, and that was less than 12 months ago. So it is an issue that is growing.
All right, if I don't see any more, then I guess we'll close out. And thank you both very much. And thanks for the questions, everyone.
Thanks, everybody. And thank you, Nick.
So it's my turn to wrap up. Right after this, we're going to have some drinks in the back. Feel free to stick around, socialize, ask any other further questions, communicate with other people. But I'm going to make this pretty quick. I'm just giving you 4 takeaways, not necessarily the most important, but the most interesting to me as I was listening to the presentations this afternoon. Number 1, carbon overhang has gotten worse. We define reserves not because that's something that's useful for the operators. That's something that's primarily useful for the markets. Even though that's the case, 10 years on, we have a bigger overhang of reserves than we actually need. We've got some kind of disconnect to the kind of information that we're giving to markets and how we're defining what reserves are, if that's the case, because at the same time, awareness about these issues has only grown. So that's the first point. Second one is something that Natalie Wallace said, is that in investing in this case right now, past is probably not prologue. It's probably not the case that we should just continue to assume that things are going to go as they have gone. Yet at the same time, if you look at trends, we see more people investing money passively. We see more people willing to use indices instead of active investment strategies to address this. And I think that's going to raise some big questions for investors. If they are going to take that approach, how are they going to deal with that? What are they going to do in terms of their stewardship activities that's going to supplement and try and get those companies to be addressing and considering some of these risks? I think the third point when you think about the stranded assets and stranded liabilities theme is that it's a double whammy. And it's a double whammy that occurs at the same time. As you have production declines, and that's not an unreasonable thing to think about. We have companies like BP that say we are going to decline our production by 40% over a decade, okay? So we already are seeing acknowledgement of that. But as you have production decline and you have these liabilities arise, there's a situation, a double whammy. Right now, they're supposed to be paid for from future cash flows, but what if those cash flows aren't going to be there? So that's really something I think that we've got to think about significantly. And the problem is pretty significant, right? One of the points Dwayne made, in the US, 93% of the wells comprise only 8% of the production. That means they're hardly producing anything. That's a substantial issue to deal with. And the last thing I want to bring up is the issue of privatizing benefits and socializing costs. Being a lawyer, a corporate lawyer, one of the fundamentals of corporate law, and this comes true in bankruptcy as well, is that you're not supposed to pay your equity holders before you've paid your debts, right? There is a hierarchy of creditors writ broad on the firm that are supposed to get paid in order, right? You shouldn't be able to distribute cash that is not supported by your balance sheet. Now, I'm not saying legally that's what's going on here, but let's think about what's actually happening when we have companies that say under a holdback analysis don't have the money and the future cash flows from their wells will never be sufficient to cover those liabilities. Is that not kind of the same thing? We're seeing distributions happen from those companies, possibly. Yes, they might be generating positive cash flows today, but should those distributions be going ahead of those obligations that otherwise might fall either to other companies, if we see them get socialized, like in the case of Australia, or socialized across industry, I should say, or to the taxpayer if they get socialized more broadly to other entities. And I think this is actually going to be a particularly thorny question for investors because who are the people that are getting those benefits? Is the ones that are invested in the companies today. So that's going to be a complex issue, but certainly one that I think investors and others have to grapple with. And with that, I just want to say thank you to Dwayne and to Stephen and to Nick, and also to Mike and Natalie and Henrik for all the interesting commentary this afternoon. Thank you all for coming, and please join us in the back for a drink.